You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That rockin' tune means it is time, once again, for Volatility Views, the premier program for volatility traders. My name is Mark Longo, coming to you from in the process of being revamped, Options Insider Studios here in the options capital of the world, indeed probably the volatility capital of the world, Chicago, Illinois. And of course, we produce quite a bit of fun content here in the old studios for your discussion and education and indeed your analysis and all sorts of other benefits, unusual activity, etc. And where can you find all that great stuff? Well, of course, the easiest place is theoptionsinsider.com. While you're there, check out our breaking news from the options market. Check out our write-ups of all the different trades going up during the day. A lot of unusual activity, a lot of analysis, education. It's all there for you. And when you had your fill of that, click on the Insider Radio Network tab, and then your journey has truly begun into the thousands of hours that is the Options Insider Radio Network. Of course, many, many hundreds of archived episodes of this program, Volatility Views. Of course, you can also find it all your major platforms, iTunes, TuneIn, Stitcher, and coming soon to the Google Play Store. Google, a little slow on the podcast tip, but all of our stuff has been submitted there, and when they do finally flip the switch and turn that Google Play podcast store on, it'll be available there as well. In the meantime, if you're an Android listener, like we always recommend, go grab our mobile app. It's probably the easiest way to get it over there on the Android side of the fence. Also available on iOS for those of you like me who can't stand the iOS podcast app. It is the most broken piece of garbage ever foisted upon the consumer public. But that's a conversation for another day. And of course, while you're listening, while you're downloading, while you're streaming, shoot us your questions, your comments, your emails, your tweets, your Facebook messages, all that fun stuff. We love to hear from you guys. And joining me on the show, I usually go in order of proximity, but this one is kind of a difficult toss-up because they're both pretty far out in the hinterlands. I guess we'll go in order of closest far away guy, starting with the corner office man himself, who tweeted out a nice picture of the corner office this week, even though it was indeed a lie. He only showed one small segment of it. He didn't want to show the full scope of the palatial estate that is his corner office. Mr. Russell Rhodes joining us, not from the corner office over there at the Options Institute this week, but indeed from a palatial classroom, an auditorium, if you will, over there in Oklahoma, where he is moving forward with his volatility doctoral degree. Mr. Russell Rhodes, welcome back to the program, sir. And what exactly are you studying over there?
I'm doing a PhD in business with at Oklahoma State University. It's a 3-year program for professionals, but it's an accredited PhD.
Here I was. I thought you had found some esoteric problem on financial, program on esoteric, financial mathematics, specializing in volatility. Here I was going down the rabbit hole for you.
Well, my dissertation, which I'm not supposed to share so nobody steals it, is along the lines of what you just said. So there's still, I can't do anything without bringing VIX into the fold. I even did a marketing paper, and it was all about VIX. I got a C on it, but still, I try to work VIX into everything.
There you go. Once you get your degree, you can be Dr. VIX. There you go. And then you can literally work VIX into everything, including your business cards. And also joining us from even farther away, if Oklahoma wasn't far enough for you listeners, then we are also joined by the greasy meatball himself. Usually he's flitting about here and around Chicago. Today he's flitting about out there near Silicon Valley, out there in San Fran, joining us probably from a Starbucks somewhere therein. Mr. Greasy Meatball, welcome back to the program, and let's play the Where's the Meatball game this week. Where exactly are you this week?
I'm in a travel inn in beautiful Sunnyvale, California. So I am in the heart of Silicon Valley. I'm about 20 feet from LinkedIn's headquarters right now. And you can actually see people crying as they exit the building all the time.
LinkedIn, Twitter. I think there's a few people. Maybe, well, not Tesla so much. We'll get to them in a minute.
I used to be rich.
Yeah. A lot of people having a rough week from a tech stock perspective. So let's get into that. Let's get right into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, like the man said, this is a Volatility Review, the portion of the show where we take a look back at the week that was, from a volatility trading and analysis perspective, and what a week it was. We sell off, we rally, we sell off, we rally. Several aggressive sell-offs, then those sell-offs somewhat muted intraday, and now here we are at the end of the week here, rallying pretty hard. But we'll get to all of that. We are recording this Friday, February 12th, for all of you playing the home game. But since Mark is out there in the Silicon Valley, the tech mecca of the world, it seems just appropriate to start in the realm of earnings vol, because we are still in the teeth of earnings season. We saw quite a week for this one as well. You mentioned Twitter taking, shall we say, a drubbing this week. A lot of people writing in with questions about Twitter volatility and things like that on some of our other programs. Maybe we'll get a few of them onto this program as well. We also saw Tesla lighting it up this week in a surprising fashion. Tesla, another one of those darlings out there, and a darlings of the street. I know a lot of our listeners like to sling some Tesla these days as well. Going into their earnings, which I believe were on Wednesday, we saw a ton of paper pouring in. It was about 4 out of 5 of every contract going up was on the put side. So the stock had already taken a nice drubbing. Good old Elon Musk off about $3.4 billion combined between his stakes there and Solar City. So it hasn't been the best year for his two holdings. And people were lining up for a lot more downside in Tesla. And then, of course, after the bell, they released a pretty terrible number and yet managed to talk themselves into a rally nonetheless with hype for the pre-orders for their new car, which is pretty much at this point vaporware because no one's really seen it. And also, it's not really going to be available for at least a year, if not a couple of years. So, but still, that was enough to rally the stock after hours, and it opened up substantially, opened up about 6% after the market was pricing in about a 16% move going into that earnings. So net underperforming from a vol perspective, but I'm sure for a lot of those people who were lining up on the put side of the fence, looking directionally, they were a little bit sad at the Musk PR machine working well again, but yet it did just that, and that's an impressive spectacle, an impressive feat in and of itself when everything else in the world is selling off they managed to talk themselves the other way. So the PR machine accounting for a nice 10 handles or so out there. And they had rallied about 20 points, I think, at one point intraday. So it was a pretty impressive run for them. Activision Blizzard, another one coming out this week. They were pricing in about a 10.5% move. We saw them selling off pretty aggressively in the after hours, getting off about $4, about 13%. That name has become a pretty interesting one to watch of late, and once again outperforming to the downside. I won't go into Groupon because that name is effectively an option, and the stock is an option at this point. So talking options on Groupon I find to be kind of silly. You also had Yelp kind of pre-announcing, if you will, thanks to the assistance of PR Newswire, I believe, or Business Wire, one of those two. Not a good time either for those stocks either in terms of the Business Wire. So a lot to bite into and kick things off with from an earnings perspective. Mark, since you're out there in the tech mecca of Silicon Valley, we'll start with you. What caught your eye this week from an earnings volatility perspective, aside from the people fleeing LinkedIn and Twitter with tears in their eyes?
Yeah, I mean, it's just, the sentiment got so bad, and some of these popular tech names have just been so creamed already that you feel like some of the awfulness of Tesla was maybe a little baked in, and maybe people were bracing for even worse than what they got, and that's what maybe saved Tesla's keister. Recall it's off pretty nicely on the year already, so I'm not entirely surprised that. Maybe they got a little lucky with the timing of their earnings announcement. I mean, if you think about it, on the first of the month, so about 10 days ago, this was a $200 stock. It's now a $150 stock. So you have to wonder whether, that earnings save was more just the fact that the awfulness was baked in.
Certainly a lot of awfulness to go around, and even with a little bit of a sell-off today, they're still up about 6-7 handles from where they closed going into the earnings. So they're still up post-announcement on that one. And again, you're right. When everyone and their mother is piling into the downside in a name like that, chances are you're probably going to pop. That just seems to be the way it breaks most of these days. Russell, I know you're busy out there working on that dissertation in the hinterlands of Oklahoma, but anything catching your eye this week from a earnings volatility perspective? Certainly a lot to chew on this week from that front.
The Tesla being down 20% from just in this month before they reported, I think it's a pretty good explanation of why it didn't continue to follow through to the downside. I know Mark and I talked a little while ago, and we both canceled our orders for the next Tesla vehicles because we just don't know exactly what we put an order in for. You
don't want to wait till 2018 for a sight unseen vehicle.
Exactly. So but you got to figure how much more can that one go down. Plus, they've got the new factory that's going to come online, and they're actually going to diversify into some other products. So, being visionary, and they've got the ability to talk themselves up a little bit. What I'm really kind of keeping an eye on is next week we've got Walmart they're gonna report their earnings Thursday before the open, and we can get all kinds of numbers from the government about how the economy's doing, but I think when you take a look, you could combine Walmart and Target together, and whatever they say, is what's really going on the ground. Much like some of the stocks that have consumer exposure over in China, it's better than any of the numbers you'd get out of them as well. So I'm looking forward to seeing what Walmart says next Thursday before the open.
Yeah, I'm with you on that one. I've always said that many times. You take Walmart and a few others, maybe throw Mickey D's and a few others in there. You get a really good sense of, ground level economics as opposed to whatever, the beige book or whatever random report out of the Fed or any other economic institute can say. That is real on the boots on the ground economic impact being seen there. So you're right. I do tend to pay a little more attention to those just to kind of get a more bellwether sense for the broad trends in the economy, and it's an interesting one to pay attention to. Not really out there in the tech land that Mark's in right now, but it's probably more relevant maybe to a lot of our listeners just in terms of what it says for the broad economy. Speaking of the broad economy, let's get to it. Oh, another crazy week on the street. If you're just watching the game, close to close, you're missing so much, even though there are some decent moves from close to close these days as well. In fact, as we're recording this today, listeners, on Friday, February 12th, we're in the green zone, with most of the major indices up well over 1%, S&P up about 1.5%, Dow up about 1.5% as well. The NASDAQ, the laggard a bit today, only up 1%. And all this combining with, of course, the holiday weekend, a bit of a premium annihilation going on out there in the S&P, a.k.a. the VIX coming in pretty aggressively. VIX cash off a little over 2 handles, and a lot of premium selling going on out there today. We'll get to that a little bit later in the VIX options flow discussion. But still, interesting stuff. But what a week it's been. I mean, just yesterday alone, it seemed like the world was ending. We were recording some shows earlier in the day, and just kind of watching the narrative shift intraday is always fascinating. And then as the day progresses, it's not really the end of the world. And then some indices actually close about unched or up, and others have mitigated the vast majority of their sell-off intraday. And it's just one of these crazy days. We saw VIX cash popping yet again earlier this week. I do kind of feel bad for you, Mark, because we'll get to the crystal ball a little bit. You were close. If you had waited about a day, your crystal ball prediction would have been right on. But yet again, the crystal ball is a fickle mistress, and she giveth and she taketh away. But VIX cash popping earlier this week, actually getting above the 30 handle intraday yesterday on Thursday, about almost 31. So getting well, if you believe that VIX level, well beyond the red zone of 25, signaling danger, Will Robinson, danger ahead. So a lot to chat about here. Maybe we'll head out and back to Silicon Valley, Mark. A lot to bite our teeth into this week, just from an overall vol perspective. So what caught your eye out there in S&P and VIX land this week?
I mean, lots of things. You had vol moving around pretty nicely. You had a lot of VIX volume. You had the VIX threatened 30. I mean, there was a moment there yesterday where things looked like they were about to fall off the rails. And then it's amazing how right as we hit these crazy key levels, like these technical levels that everyone in the world is watching, some OPEC minister comes out and says, we give up. And it continually astounds me that happens. But that's the way kind of things have been moving, and it's been pretty shocking that the kind of snap that we've rallied. We're only up about 23 now, but we're about $60 off, $50 off the bottom, and I mean it's just a pretty nutty move.
Yeah, I think nutty is is probably a good way to watch. That's why I say, you got to watch these things, just how they unfold intraday, because the intraday range on some of these days is just crazy. I think yesterday we had like a 37 handle range in the SPOOs or something along those lines. Today we're already looking at about a 26 handle range so far intraday. So yeah, and the day is only partially done, so a lot more to go. Russell, obviously a lot to bite off here. VIX cash breaking through that off-sided, very important. Take your ball and go home 30 level, if briefly, if only intraday. But again, if you believe the Goldman, then we're well past the 25 level, which is where the economy melts down. A lot of intraday vol, VVIX, other things really going off the charts. So what amongst all this volatility storm really caught your eye this week?
Yesterday, we had the February future close at over a 2-point premium to the March future. And we've only had that happen a couple of times this year. And I almost, and I didn't want to pull myself into a big debate on Twitter, but I almost said that that's more of a fear index than VIX by itself these days, is taking a look at how far into backwardation we are with front month versus second month. And the last couple of times this happened, we tend to stabilize a little bit. We didn't necessarily rally off of that, but we've fallen back below that 2-point spread once again.
It is amazing just this week how much analysis I've seen going on the vagaries and nuances of both the S&P and the VIX futures term structure out there, and the flatness or relative flatness, or compared to this portion of time last year, the degree of steepness in the curve and vice versa. It seems like just given where we are in this day and age and how much volatility is on everyone's brain, things like term structure of volatility have become almost commonplace discussions, which is kind of heartening to see, quite frankly. You can throw out things like discussing a VIX futures term structure, and you're not going to blow the minds of even a lot of the retail populace out there, which it goes to show again how far and wide the reach of volatility has spread. And let's focus our reach then on some of that activity we actually saw this week, starting with, I know, Mark's favorite segment, and it always gives me a good chuckle as well. It's time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
I still love that. That's pretty good. I can play it again for you if you need it, Mr. Russell.
Well, when do I get my where in the world is the meatball theme song?
We're working on it. We need some sort of tone for that one first. Once we figure that out, we'll hit that out. The Russell one was pretty obvious. That was an easy one to hit out the park. All right, Mr. Russell, where has your weekly gaze fallen this week, sir?
So far, it seems like anything of size is still looking out to March 9th. We've got relatively, next week, February 17th is a standard VIX expiration date. So, there's not a whole lot going on in the weekly space, but anything that seems to have even moderate size looks like it's concentrating on that March 9th date, which is, again, the first VIX expiration after the February employment number, which will be reported on the first Friday of March. Today, it's kind of interesting. With the volatility lower this morning, somebody came in and bought the March 25 calls and sold the March 28 calls. And that March 25 strike, the March 9th 25 call strike. That's something I think we even talked about last week, but that seems to be a number that has gathered some interest. But that's pretty much it. The open interest is fairly light for the February contracts, which is lower than the 50 to 100,000 range that we're used to. I think maybe it's that we're through earnings season. We don't have a lot on the economic calendar for the next couple of weeks, and they're looking out beyond. Now, one thing to keep in mind is the last time I saw this sort of activity in the shorter dated volatility trading was late August, when everybody seemed to be looking past Labor Day. And then the Chinese came up, they snuck up on us and they slammed our market. So that complacency may be leaving us open for maybe new lows before the month's out in the S&P 500.
Uh-oh, so you're saying August 24th, part 2 here in February. That's what you're saying? That's what you're hinting at, sir?
Yeah, I mean, the difficulty in finding shorter dated activity that I had in late August, it's kind of the same feeling right now. I mean, I know that we're not, that we've experienced some sell-offs, but complacency often leaves the door open for a little bit of excess downside volatility. So we'll see. But nobody seems to be prepared for it, at least until early March.
Yeah, complacency combined with the everyone kind of heading for the hills, thin markets as a result of an impending holiday, and a few other things. Throw all that into the cauldron, you get a pretty toxic or potentially toxic mixture. Looking at the broad VIX complex, it's been a pretty robust week, shall we say, from a volume perspective, with about 3 days well over the ADV, which is hovering around 580,000 right now, with about Monday leading the charge, 830,000 contracts on Monday. So a pretty strong volume week, about 767 on Tuesday. Wednesday, pretty light, only 400,000 contracts going up. And then yesterday, Thursday, I told you with all that intraday volatility, huge range on the SPOOs, huge range on most of the indices. Volatility rocking and rolling. Yesterday was really the leading the charge this week so far, about 1.2 million contracts going up. Today we're hovering about 450,000 contracts. Looks like probably, if all goes well throughout the rest of the day, probably another plus ADV day again today, but we shall see. Perhaps something else. Well, this market has been known to rock and roll in the final minutes and hours, so the story has only begun so far for today's volume. We might see a lot of interesting stuff. And the narrative was flipping along with the VIX earlier this week, and it kind of depended what we saw going on is really where we saw a lot of stuff lining up. We did see some sizable buyers of premium coming in earlier this week. We did see an interesting narrative shift throughout the week with some decent-sized trades going up. Yesterday, obviously, was just Thursday just being just a slew of paper everywhere across the board. Kind of hard to find one narrative throughout that. Kind of depended what time of the day you were looking. Big trades going up on the 40 handle out there. In Feb yesterday, paper dumping about 25,000 of those for about 20 cents, out there. So big dumps coming on towards the end of the day, and that kind of narrative has continued into today. You can call today kind of a bit of a premium selling palooza if you want, with a lot of, obviously, of course, the rally feeding into that, the impending holiday weekend. We are, of course, closed here on Monday in the States. Listeners and markets are closed, so an protracted holiday weekend. The combination of those two things apparently making everyone forget that they were bidding this thing up over 30 just yesterday. So how short the memories are out there in the volatility space, as everyone and their mother crushing things. About 40,000 of the Feb 30s going up this morning. Paper selling for about 70 cents, and that's pretty much when the premium selling bonanza began out there today. I anticipate this going to continue for a little while. We'll see, at least today, as we are talking today. The VIX cash hovering right around that 26 level out there. Mark, we saw a lot of back and forth paper this week out there in VIX land. Obviously, this latter part of the week into today, leaning towards a premium selling side, but a lot of back and forth paper earlier this week. Anything really catching your eye out there as the week progressed?
You know, there's no crazy paper in VIX itself that made me really think. There was a couple of relatively big buyers of the March 30-40 call spread, but that went up in size, but it was mostly crossed, and that was really the only really massive trade-off I saw all week. The guy did 100 some odd thousand of those. Aside from that, I did not see a lot of massive orders that really, and when I say massive, I mean more than 10,000 contracts. I mean, I see probably on a daily basis, I see 10, 15 trades of 25 to 5,000 in that thing. I'm looking through my order book, and the other big trade that I saw was an April 16 put buyer that bought about 15,000 of them. So that's the biggest one I saw outside of that March 30-40 call spread.
Yeah, you can find 10,000 lots just about anything you want, any trade you want out there in VIX land. There's so much paper going up, but you're right. The puts stand out a little bit when you see 10,000 plus of any put going up. It kind of raises your eyebrows a little bit out there in VIX land, just because we still don't see a lot of put love. In fact, getting to the top 10 hot strikes this week, got to get all the way down to number 7. At least we have a couple puts in the top 10 this week. I'll get on number 7 to find the first put. But let's start where we like to do. Number 1, the not surprisingly, getting all this talk about the verticals and how I mentioned flirting with the 30 handle earlier this week. That 30 handle and that 30 strike becoming not perhaps as Crazytown as it seemed even a week ago when we were talking about it on this show, with leading the charge sizably is the March 30 calls coming in with about 423,000 contracts open. So clearly the strike du jour, March 30, is where the action is, then dropping off a cliff, almost 200,000 contracts down to about 239,000 for the March 35s, ever more optimistic. Then we keep going up the optimism chart and down the volume chart to number 3, the March 40s. Again, getting back to that vertical we were talking about earlier, with about 227,000 open on the March 40s. And then we get a little bit closer to home, number 4, the Feb 40s, with about 200,000 even. Then it kind of falls off from there, about 200,000 again, or a little bit less, of the March 27s. Number 6, the Feb 30s, with about 180,000 contracts. Then all the way down to number 7 to find our first put on the list, the March 20 put, with about 166,000 contracts open, then falling off again. March 23 calls, about 125,000. Number 9, the March 23 calls to number 8. Number 9, the March 25 calls with about 120,000. And then rounding out the list, number 10, one more put snuck in there, just barely. 110,000 of the March 18 puts going up. Total open interest, like Russell said, not overwhelming, but not bad. 6.8 million, almost 6.9 million contracts outstanding. About 4.65 on the calls, about 2.2 on the puts. So nothing outrageous from a call to put ratio yet either out there. So we're still kind of waiting for that other shoe to drop out there in broad VIX land. And let's move on into some of our other products we like to talk about. There's been a lot of movement in a lot of products this week that were kind of interesting. We'll get to the shiny stuff in a little bit too, because I think that merits discussing on the show this week, given all the back and forth, or I should say really rallying going on out there in VIX land. Maybe even before we do that, though, Mr. Russell Rhodes, I hear you beaming in from your palatial classroom, auditorium, if you will, over there in scenic Oklahoma. What else caught your eye in the week that was from a vol perspective?
Well, Mark mentioned the buyer of the 16 puts. I saw that print as well, and I went down and talked to the DPMs about it a little bit. And there had been a trader that was coming in and buying the weekly 16 puts. They seem to have gone away for a little while, and I just assumed that big buyer of the standard March expiration puts was the same guy, but they said it was actually a different one. So it looks like there's more than one trader floating around there looking for, or setting themselves up in case we get a dramatic drop in volatility. I don't know if they're using that as a hedge against a market short or what, but it's just interesting. As you mentioned, all of the big strikes always seem to be, or the big open interest, are the ones that we're most interested in, are the calls. But somebody might be doing the inverse, or more than one trader might be doing the inverse and using downside puts to hedge against something as well.
Two traders trading in the same put strike, different months at the same time. That's a conspiracy, I tell you, sir.
Or it's like-mindedness.
This is why I like having Russell on the show, because every once in a while he feels the urge to get up out of the grand palatial estate and indeed his massage chair in the corner office and walk on down and talk to the DPM and say, hey, what's going on with their puts or their calls or whatever is catching his eye. So we like that proximity, Russell. We take advantage of it all the time here on the program. Moving on to another thing that was rocking and rolling this week. Crude, really just moving a lot. Also, crude vol. I'm not sure if you guys saw this. I was in the middle of doing a show earlier this week. I believe it was on Wednesday. And I saw this just crazy print going up out in OIV of like 30 handles off of where it was. I haven't had a chance to dig into this, but according to the prints, it was hovering around OIV. Of course, the crude oil VIX, the crude oil vol, its counterpart sister being the OVX, the USO vol. And we saw a crazy print in OIV up to 105, which is well beyond any recent level this thing has printed at in a long time. I looked at OVX. Didn't see any commensurate print. I don't know, Russell and Mark, if this one caught your eye as well. I kind of wrote it off as a bit of an aberrant print, but it was so far out of the realm of normal that I thought maybe, do you guys see anything going on out there that might have backed that up, or is it just Crazytown?
I'm going with Crazytown. I pulled up OVX versus OIV charts side by side. This one OIV is based on the options on the futures, and my assumption is maybe they spread the options out for just a moment or two, and using the midpoint of that quote, they got what amounts to maybe a bad print. So I would chalk that one up to just market volatility for a second, and using option quotes that are a little bit out of the norm.
But let's talk about OIV and how crazy, and OVX and how crazy they are. OIV is now approaching like 2008 levels. The VIX touched out at 87, and we've now had a couple of days in a row where oil vol's over 80. And this is getting at levels where all I want to do is put my hands out and say sold, because it is so juicy and pricey. They're like begging you to put on put 1x2s. I'm having trouble fathoming oil being able to move at 80%. I'm looking at USO, and I can sell July vol in the 60s. I can sell April vol in the 70s. I mean, Jan 2018 vol is in the 50s. This complex is now at complete and utter chaos, panic. Nothing is right. We're all scared. We're all going out of business. The world is ending levels. And I just don't think it's sustainable at this point. And it shows, and I think it's got to point toward somewhere near a top in oil vol, and potentially a top in and nearing a bottom in oil itself.
Yeah, Crazytown pretty much across the board here in crude land this week, not just with crazy prints. That's what you get when you have essentially a derivative. You get those aberrant prints every now and then, but you're right, Mark. The skew is still lining up pretty wacky out there, and if you filter out kind of the front month there, which is Crazytown and get pretty much going out anyway, you get into some of those later months on the skew, and we'll try to include this in the notes for you guys so you can see it as well, listeners, out there, particularly in WTI, which is where we're looking right now. You're right, there still is a hefty premium going out for a while. going out for beyond this year out there in the put wing, which you would think, given the levels we're seeing right now, and we kind of remarked on this in the end of last year, and we saw something similar lining up. Crude was still markedly higher then. It was about in the mid-30 handle or so. And now that we have had yet another sell-off, and still there's still a pronounced bid to these puts. You're right. You can do 1x2s and ratios to the downside pretty much all day long and do them, if not for credits, then pretty darn close. So yeah, it is surprising to see that there still is that much structural concern out there in the broad crude markets. I mean, at the end of the day, you have to kind of wonder percentage-wise how much left to the downside there could be. But again, we've said that for a while now, and yet crude continues to surprise to the downside. And whenever there are moments when OPEC or the rumored OPEC-Russian collusion and everything else could have stepped in and stemmed some of the some of the tide, stemmed some of the production, nope, they've kind of dropped the ball at every moment. They clearly don't really want to support it. So it remains to be seen. Clearly, looking at the skew out here, people are still concerned about more shocks to the downside, more so than they are loading up on upside with any sort of aggressive vigor. Anything else on crude, Mr. Corner Office, before we move on into the shiny stuff?
Well, you just got to find it fascinating that the concern is to the downside when, if you look at the last 2-year range and how much closer we are to the lows than the highs. And also I remember when the biggest risk in oil was the geopolitical risk, and it's amazing that nobody takes that into account with small blowups going on in the Middle East all the time. I hate to say it's a different scenario now, but it really is kind of different for oil and what influences oil.
I'm looking here at two different skew charts, one for crude WTI, one for gold. And if you just removed, the legends from these graphs and you just put one in front of me, you might, and you just didn't know anything about historical crude. You just happened to see a chart of where crude is now and see where it was like a year ago or so, and you had to guess which one was which. You look at the gold skew chart and you'd say, well, that clearly is crude because everyone and their mother is buying calls because how much lower can it go? And yet that's exactly the way things seem to be playing out there in the shiny stuff this week. Of course, you've been watching this. Gold finally waking up to the fact that it is indeed the flight to quality spot. When everything else is going to hell, go to gold. And apparently it's finally starting to deliver on that front this week with some sustained rallies over the course of the last week or so, starting to make Mr. Greenspan's pick of gold about a couple of months back look somewhat prescient. But that said, the call skew, if you want to talk about crazy skew, we said the puts have a somewhat bid in WTI, but gold across the board, I don't care where you're looking, GLD and the big futures options here on Globex, wherever you're looking, the call skew is just, I think to call it redonkulous, the technical term. This is reminiscent, Mark, to me of the old heydays of Apple earnings. Got to get calls, got to have them. Can't. You're talking verticals. This is the place where you could seriously do them for aggressive credits if you were so inclined.
Yeah, and when you see commodities are a little different, but when you see something getting that kind of an aggressive call skew, it's almost always a sign that the move's over, or at least is nearing an end. And I could definitely see gold getting toward that level. It makes an interesting butterfly candidate or broken wing butterfly, but that vol got just so out of whack. It went from about 12 to about 30 in 2 or 3 days. Just nutty volatility move in gold.
Yeah, I think nutty is the only way to talk about it. And, of course, clearly, people a lot of times maybe they trade GLD, so it's something you can put in a securities account. So they think of gold in that same mindset where it's going to have the investment skew that everything else like an Apple or an S&P pretty much has. And, of course, clearly it's a commodity, and commodity skew tends to lean to the upside. So we don't this is not a surprise, but just the severity, the steepness of this and the market change we've seen very recently is indeed a surprise and worthy of note. So if you're out there trading this stuff, it's definitely something to take a look at as you're setting up your trades. I know, Russell, you're not very much a shiny stuff guy, but I'd imagine even you out in the hinterlands of Oklahoma had to be at least intrigued by what we saw lining up from a vol perspective this week out there in gold.
Well, beyond a vol perspective, you've got to question a rally in gold with the macro environment that includes, I've heard up to a third of all government debt in the world is paying negative interest rates right now. And that, if the academics hold up, that's supposed to lead to deflation. And I think one of the last things in the world you want to own is gold if we're going to be in some sort of deflationary environment. So maybe it's a flight. I can see it from the flight to quality, but it's one of these situations where I think the fundamentals might not justify any sort of rally in gold right now.
Academic economists, they're the same ones who taught me in school that the Phillips curve had some actual bearing on life. So you have to always take that with a grain of salt. But you're right, it does raise a few interesting questions. Speaking of questions, it's time for you guys to do just that. It's time for us to check out the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Vol Voicemail. This is, of course, the portion of the show where you guys get to take the reins and direct the conversation flow however you like. And we're going to kick things off, actually, looking back a little bit. We were talking on the last episode and the one before about the perhaps impending launch of dailies and perhaps the interest therein. We talked recently about the SIBO now adding the expiring on Wednesday weekly, or Wednesday weekly, I believe they're calling them, to the mix. So effectively having now 2 days of expiration every week, or coming forward once those products launch, which of course leads to the assumption they're going to add more of those and fill up the whole week. And then of course we're going to effectively have dailies firing off essentially every day. So that led us to ask on our Twitter. We like to have these options, these broad options thought questions every week, and we had one this week of, should the options market add daily options? And so far, I think there's a day or two left on this poll, but so far, surprisingly, resoundingly against the concept of a daily. And what I mean by a daily, of course, is that kind of pure list in the morning, expire in the close on the afternoon kind of thing, not the weekly version, with about 40% saying, heck no, we want nothing to do with the weekly, which that really surprised me, given some of the feedback we've had on some of the other discussions on this topic on other programs. It seemed like people were roundly in support of it. Only 34% coming in yelling, of course, and then some people, about a quarter, saying they prefer the weeklies, which I can understand. A lot of the use case of the near duration, short duration contracts has fallen into the premium harvesting side of the spectrum, and a weekly seems to be right in that sweet spot, that Goldilocks spot, where it's short enough to decay rapidly, but long enough to have a little bit of meat on the bone to be worth selling. Whereas a daily, I think a lot of people who are in the premium harvesting side of the fence, they really kind of look at that and say, what do I want with that? So it's really more of a premium buying risk mitigation type tool. And that really, we haven't seen a lot of people coalesce around that use case for the short duration stuff, at least on the listed equity and index side. On the futures option side, people do buy those weeklies in a surprising amount, but not so much on the equity and index side. And then about the 4% saying others, they like some other things like the futures options and things like that. So that surprised me, Russell. Does that surprise you too? I know you guys are working into or expanding the reach of the weeklies. Does that surprise you that so many people, at least so far, are resoundingly and surprisingly against the concept of a daily?
Well, when you're when you throw dailies out, I think a lot of people think that you're talking about an option that starts trading one morning and then expires that afternoon.
Well, that is what I'm talking. For this case, that is what we're talking about.
But and you can come up with different definitions of dailies. You could always say that, well, we're just going to have options that expire every day of the week, which might make a little bit more sense. Would be kind of overwhelming, but would make a little bit more sense. I don't think that there would be a lot of interest in options that you cannot hold at least one evening. I think a lot of people, there are too many traders that want to try to take a position today for something that may happen tomorrow. So I voted no, but I didn't put my explanation on there. And my explanation was at least having options that have 2 or 3 days would make a little bit more sense. I think selecting expirations the trading day after earnings would be awesome. But again, trying to keep all that straight might be a bit overwhelming as well.
Yeah, it's kind of hard to convey all that nuance in a quick Twitter poll.
Right.
That's why we leave that other part open for people who feel compelled to unburden themselves of what they're actually viewing. Mark, does that surprise you at all on the dailies, or are you on the same front as Russell?
Well, yeah, and let's think about what this leaves you open to. When you're dealing with a daily, what you're really dealing with is what amounts to a binary option, and there's a reason why Nadex is a great approach and does provide a service. Is not completely blowing up, and it also, especially in our environment, opens up just the market to be rife with front running. And I could see Citadel having a field day trading these things, quote unquote, making a market $1 billion wide and then just picking off every market maker left and right. So I think a daily option in and of itself is an awful idea. The weekly options expiring every day, on the other hand, I think is a brilliant idea.
That seems to be the way it's shaken out, and at least according to our poll, that appears to be the way the market wants it. So there you go. If you're not following us there at Options on Twitter, listeners are going to do a lot more of these, so you guys can weigh in with your thoughts. And if you have all these nuanced opinions like Russell, you can put them in the other category. We'll try to leave that open for you, so you can espouse as much as you want, given the limited nature of Twitter. Moving on to some other questions here. We got one from Hot Emini. I like that handle. He writes, hey, there's a big disconnect in retail that Theta is all, but isn't Vega the king Greek for pros? What about Gamma? Where does that fall in the mix? So a little bit of a disconnect with retail. I actually might take a little bit of issue with that first statement. I've always kind of denoted the difference, the demarcation between retail and professional. Professional clearly focused on the Vega, obviously, but I've always thought of retail predominantly being delta focused. They come in, they look at an underlying, they like Apple, Facebook, what have you, GLD, and they say, I think it's going to rally, I want to buy a call, or I think it's going to drop, I want to buy a put, et cetera, et cetera. That's kind of the starting point for a lot of their trading. Then it kind of evolves from there. They get into spreads, they get into other things like that. But effectively, when they look at the marketplace, they still look at it from a predominantly delta-oriented mindset, because a lot of them come from the stock world. They're used to buying stocks and buying mutual funds and things that are predominantly delta one, directionally oriented. And so it's kind of hard to abandon that mindset when you come into options for the first time. Whereas anyone who came up through the market making system, at the end of the day, delta, you hedge that away right away. So you don't even really look at delta. And then, of course, you're looking at things like Vega and your skew, and that's really where you're making or losing the lion's share of your money. And of course, Theta becomes a component of there as well. And once the retail gets a little bit more savvy, they start to lean maybe a little bit more in the Theta side of the camp as well, hence all the interest in the weeklies that we're seeing these days, which is pretty much 80-90% Theta harvesting. So that isn't delta really at all. So yeah, they do come around to Theta, and they ask, what about Gamma? That is a good question. I think, Russell, we were talking about this not that long ago, and we were talking about, I think, our second order Greeks discussion, a little bit about Gamma. By the way, I was watching the Madoff miniseries this week, and they mentioned Gamma on it. They actually discuss Gamma on the Madoff miniseries, so that gets my thumbs up for the most sophisticated depiction of options I've ever seen in any medium, fictionally, because they actually mentioned Gamma. That's a discussion for another day. But what do you have to say here for our friend, Mr. or perhaps Mrs. Hot Emini, wants to know what about Gamma? Where does that fall in the mix for retail as well as for professionals?
Well, I kind of agree with both of you where, you mentioned that delta is what retail investors or traders tend to focus on the most. And they do when I get started with them, but I try to steer them toward Theta because I feel like individuals need to learn how to offset some of the time decay that they have to overcome when they've got a delta outlook. And one of my blanket statements is that retail traders are not going to be successful if all they ever do is buy options. So I do try to take them from delta to theta when I first get hold of them, and of course vega is what the professionals are paying a lot more attention to, at least the professionals that are focused on the option market. When you talk about professionals that are using options for portfolio management purposes, they're probably a little bit more focused on theta as well. They're just selling a call as an exit strategy and trying to benefit a little bit from time decay, just like the retail guys.
Yeah, certainly look at a lot of the large institutional use case. It is hedging and, of course, getting income from something as basic as a covered call. And that's pretty much 90% of the options use case out there. And you see that reflected in the skews of a lot of big names that are widely held, like a lot of the big tech names and others like that, because that's how the funds use them. So you're right, that certainly is a common use case. But interesting stuff nonetheless. Mark, anything to add here before we move on from the Vol voicemail?
There's like a flow chart of retail blowups, and it starts with the guys that are making directional bets, betting on delta, getting beat by theta. Then you move into the guys who are looking to harvest premium, getting absolutely crushed by gamma because they don't understand how gamma and theta are interrelated. Then from there, finally, they start to put all those pieces together, and then they start getting into the ones that get into complex spreads are the ones that really look at vega. The thing you got to remember about retail traders is they almost always have some sort of delta on. And so what really tends to kill them is gamma. And I've seen more retail traders blow up because of them not understanding gamma than just about any other Greek. So I'd like to see retail traders, for what most of them are trying to do in the premium harvesting side, Vega's important, but especially if they're going to trade weeklies and they're going to trade that type of stuff, it's not as important, especially if they're doing 3 and 5 point vertical spreads. What's going to kill them is gamma, and that's what they should be concentrating on if they're just getting into the idea of premium harvesting. If you don't understand gamma, you shouldn't be selling premium.
I like that idea of the options danger flow chart, or perhaps Venn diagram. Maybe that'll be your homework for next week. You draw up a nice little chart, and we could share it on the show of all the myriad danger zones for retail as they evolve throughout the course of options. I like that. Good idea. Well done, sir. You gave yourself a nice assignment for next week. As we keep on rolling into our final segment, it's time for the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
Okay, it's time for that most dangerous, most difficult, most precarious portion of the program where we break down or attempt to break down what the VIX gods hold in store for the week to come, and just to show how capricious the volatility gods are. Here we were. This show was recorded yesterday. Then I think Mark's prediction of last week of in that 29 to 30 range, which seemed so outlandish last week, would have been right on the mark. We were hovering right around there. Of course, today going into the long weekend, nice rally behind us, coming off pretty aggressively, still hovering in that 26 range, which puts it more in the elevated, but I think you said 2016 lows in SPX, but not corresponding highs in VIX was your actual terminology, Russell. So you got in that 25 to 26 range, which is about where we are right now. And I got to stop going last because that means I have to pick some sort of crazy number. I picked 23, 24, even though I wasn't feeling in my bones crazy elevated vol this week. So I kind of had some skin in that one. So far, at least 26 being the order of the day. Russell, you came closest without going over. So the old Price is Right rules, you get to go first. What's your call for next week here on the VIX gods for this coming Friday?
I get to go first. I don't know if that's good or bad.
Yeah, it's a dubious distinction.
I actually, I wish we were doing this for 2 weeks, but I'm thinking high. I'll take the high end over anything that you guys guess, because you're getting this sense of complacency. So we're going to need a bigger shock to the market, and I don't think we're out of the woods quite yet. So I could see a close over 30 next week.
So if I say something crazy like 40, it means you have to say like 45, right? Because you have to be higher.
Yeah, sure. Why not? Somebody was out there buying the 40s and 45 calls, so why not?
I'm tempted to say that just to push you into that extreme range, but I won't go that far up. Mark, where do you? Or maybe Mark wants to. You know, Mark likes to poke the bear every now and then. Mark, where are you falling next week? Make Russell go high.
I think it's going to depend on the Chinese, and maybe a little bit on China. They've been closed for the last week, and if you look historically, last year this week was not that great. So if the Chinese markets open up in a bit of a problem, Russell could be right. If things seem to get a little more normal and we calm down here for a bit, we're through earnings season. Stocks are companies that have boards are able to actually buy back some of their stock. We could see a little bit of lessening of volatility for the next week or two. And then so I'm actually on the board on the VIX might be heading back toward 20 camp.
Wow, we got polar extremes. 120 on one end. We got Russell saying ever higher than anyone else. I'm tempted to go a little higher than I think just to push Russell into some extreme category, but I'm going to hover with about the mid 20 level as well. So I'm going to come in about the 25. I don't think we're going to give up that much, but I don't. Of course, I was wrong last week. We got elevated, and the futures are certainly leaning towards some sort of something dire lurking in the woods. It's not all done yet, but I'm going to say a little bit comes off. I'm going to say in this 25 to 26 range. So Russell, let's say that unofficially puts you in the 28, 29 range. How about that?
All right, I'll go with that.
Okay, cool. So 25, 26 for me. Mark around the 20 handle. So kind of flipping the script from last week, and Russell in the ever so. I'm going to put him as higher than everybody. I like that. All right. And with that, we have to bring to an end another episode of Volatility Views. Always fun as always. This week beaming in from hither and yon all over this beautiful country of ours, talking vol. And so before we wrap up, let's check back in one last time with our cohorts here. Starting with he of corner office / auditorium fame, Mr. Rhodes. I hear you guys have a little conference coming up. Why don't you tell our listeners a little bit about the RMC, when it is, and what they can expect from it?
Well, RMC it's Florida this year, and it's gonna be very SPX rut and VIX centric. We've got a lot of new speakers coming this year, but you can find out about it at cboermc.com. Before then, I'm actually going to be at Traders Expo in New York in about a week and a half, talking VIX, and Kevin Devitt, who's one of our new instructors, is actually going to be speaking RUT there. We're going to do a half-day deal at the Traders Expo in New York, which is a week later than it normally is. It's normally President's Day weekend, but they pushed it back this year. I didn't realize that President's Day was a market holiday because I had been working it at Traders Expo for so long.
Not the first person to tell me that this week. They were surprised that we got President's Day off. I was like, where you been? But yeah, so if you're out there in the East Coast, listeners, maybe you're heading up to the Traders Expo. You want to see Russell, and I know Kevin as well. He does a pretty good job. Talk all things RUT and VIX and everything else, then surf on over there. And of course, check out CBOE's RMC conference. Just search CBOE RMC there on the web for information on that event. We'll, of course, be down there doing our Vol Views show, as well as some interesting interviews and stuff. So if for some reason you can't make it, don't worry. We'll keep you in the loop on all the fun, interesting developments coming out of the land of RMC. And Mr. Greasy Meatball, what's cooking for you? Why are you out on the West Coast? And what's cooking in the land of the pit?
I was meeting with the Silicon Valley Options Group here, and then I'm meeting with the Tops Option Group on Saturday. I'm going up to Live Vol's offices today, and one of the things we might be tossing around are some option pit related indicators that maybe can go into the Live Vol X platform or the Live Vol platform. And so stay tuned for that. I'm going to be doing a webinar next week sometime, probably Thursday. And if you are newer to options but interested in volatility, you want to learn really how options work, go to www.optionpit.com/begincamp, and our beginner boot camp starts.
There you go, listeners. Surf on over to optionpit.com to learn more. And you mentioned our friends over there at Live Vol. Of course, the show brought to you by CBOE Live Vol, as well as our friends over there at Russell. If you want to get a free trial, you're kind of wondering how we get all this great analytics and data that we discussed during the show, surf on over to livevol.com. You'll see a little green button there that says get the free trial. Click on it. It's free. Nothing to lose, and you can follow along with all the fun free stats we talk about here on the program every episode. And on behalf of Mark and Russell, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show, and of course for sending in such great questions. Keep them coming. And we'll see you next week right here on Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.